The Long-Term Care Insurance Task Force recommends a payroll deduction that, if passed by the legislature, may impact the take-home pay of those working in California, including the self-employed. Even residents of neighboring states like Arizona, Nevada, and Oregon, who work in California, might be subject to this payroll deduction. You may want to consider purchasing a private long-term care insurance policy before the California state legislature passes any public long-term care program. To be clear, the legislature has not decided to implement a public program at this time. First, here's some background. California Assembly Bill AB567 created a long-term care insurance task force to examine the components necessary to design and implement a statewide long-term care insurance program. The program may be similar to Washington State's WaCares Fund, which was finalized in April 2021. A federal judge recently upheld Washington State's program, and Washington State began collecting the payroll deduction on July 1st. Washington is the first state to establish a social insurance program to help fund long-term care. After a vesting period, WaCares Fund participants will be able to receive $36,500 of long-term care benefits over their lifetime, adjusted for inflation. In addition to Washington and California, 13 other states, including New York, are beginning to develop similar programs. The Washington law allowed anyone to opt out of the payroll deduction if they owned a private long-term care insurance policy. In the first version of the law, there was a 20-month window from April 30, 2021 through December 31, 2022, to buy a private long-term care insurance policy and opt out of the program. The second version of the law reversed that. It only allowed employees to opt out if they had already owned a long-term care insurance policy before the law was signed in 2019. In the final version of the Washington state law, there was a 6-month window to buy a private long-term care insurance policy to opt out of the payroll deduction. That window lasted from April 30th to October 31st, 2021. Over 480,000 employees in Washington state purchased private long-term care insurance during that 6-month window and opted out of the payroll deduction. Because of the one-time opt-out, the state of Washington will lose hundreds of millions of dollars of revenue every year. The Washington Long-Term Care Trust payroll deduction is uncapped. It equals 0.58% of all W-2 wages, including salary, stock options, employee stock purchase plans, and cash bonuses. According to a study by the state of Washington, the average income of those who opted out was over $200,000 per year. For high-income earners, the cost to own a small private long-term care insurance policy was less than the payroll deduction of 0.58%. California's Long-Term Care Insurance Task Force has created 5 different program designs to be considered by the California legislature. All 5 designs would require a payroll tax, split between employees and employers, and a non-voluntary premium contribution via an income tax for the self-employed. 2 of the 5 designs have significantly richer benefits than Washington State's program. The actuary on the task force estimated that the program design preferred by the task force would require a payroll tax of no less than 2.0% and possibly as high as 3.5%. To avoid a shortfall like Washington's program, the task force recommends that the California legislature not allow any window for California workers to opt out of the program. In their report to the legislature, the task force stated, while including a time-limited opt-out window would increase flexibility for prospective private insurance consumers, a surge in private insurance applications would likely occur in the months leading up to the deadline, similar to what happened with the Washington Cares Fund. To mitigate this outcome, legislation enacting the program should set a deadline, that is the date the governor signs the legislation, which would make any new long-term care policy sales ineligible for program opt-out after the deadline. The task force discussed 5 different opt-out deadlines and favored 2. The program effective date, estimated to be January 1, 2025, or the beginning of the year preceding the program effective date. If enacted and if the legislature chooses number 2, and if the program effective date is January 1, 2025, then the deadline for purchasing a long-term care insurance policy would be January 1, 2024. Let me say that again. If the legislature enacts the program and chooses number 2, and the program effective date is January 1st, 2025, then the deadline for purchasing a long-term care insurance policy would be January 1st, 2024. Please see pages 35 and 36 of the Task Force Feasibility Report. If enacted, what will the final version of California's long-term care program look like? If enacted, will the deadline for owning long-term care insurance be January 1st, 2024? If enacted, will it be October 1st, 2024, the governor's estimated date to sign the bill? If enacted, will it be January 1st, 2025, the estimated effective date? Or will it be after that? No one knows for sure. If you have above average income, the safe bet may be to buy a modest long-term care insurance policy now before the law is finalized. No one should buy a private long-term care insurance policy only to opt out of a public long-term care program. Private long-term care insurance is for people with enough income or assets to protect to justify the cost of the policy. Get a quote via email. No phone number is required. There's no need to speak with an agent. Just complete the form below, and within a few hours, we'll email your quote along with detailed policy information and what steps are needed to apply for a policy. Thank you for watching.